After back-to-back years of double-digit positive returns, the global markets have finally given up. High inflation, the threat of war, and political uncertainty is a bubbling cauldron where red graphs and bear markets are born. Stock exchanges all around the world are crumbling, and the panic has started to set in, as investors all around the country are getting stressed, wondering what we can do to combat the impending doom of a stock market crash. But today, I'm going to keep a level head whilst we go through my InvestEngine portfolio update, and I'll also make sure to show you the most simple tip that you can use to make sure that you keep your nerves during this market downturn. Also, I'll make sure to explain why this portfolio of the month is going to help you get better returns in these dire circumstances. Because bear markets suck, and every stock market all around the world has taken an absolute beating recently. With nowhere to hide, all we can do is stare at our phones, watch the red graphs fall, and watch the numbers in our investment accounts get smaller. Despite this being as stupid as it looks and sounds, we all do it anyway, so what can we actually do instead to make sure that we're getting the most out of these savage markets? Well, when you're at work with your head lost in a financial spreadsheet and you have no idea what you're doing and the only thing that you want to do is punch a screen, you take a break. Get up and go and have a coffee. Why? Because you can disengage, clear your mind and keep a cool head, instead of sitting there facing the same problem getting nowhere. Research shows that short breaks can improve your levels of engagement, focus and motivation, and stock market returns. Okay, I might have added that last bit on myself, but let me show you exactly what I mean by that. Looking at VWRL's returns year to date, we can confirm the awful month that we've seen so far. It's been a slippery slope. Ouch. By sitting and staring at this for so long, you're going to drive yourself insane. You're going to start panicking, and you're probably going to want to start fiddling with your investments or changing your allocations. This graph from Vanguard shows how doing exactly that hurts us in the long run. Investors trail actual fund returns across the board because of these behavioural imperfections. But back to the graph, and a wise man once said, if in doubt, zoom out. So if you do this magic thing by clicking 1 year returns, suddenly everything looks fine because you gain a bit of perspective. When focusing on a long-term mindset with investing, you'll start to realise that some of these market blips are meaningless. You'll probably forget about half of the market blips that some people got so stressed about, so don't waste your time worrying about them. Instead, why not look at these blips as the perfect buying opportunity? You're probably going to invest some money this month anyway, so why not be happy that your purchases are going to come with a huge discount? All you have to do is look at some previous market blips and take a look at what happened right after. On the run up to Christmas, we had a blip, followed by a spike. In late November, we had another blip, followed by a spike. The whole of September was basically a blip, followed by a huge rally. Or you can zoom out even further. Look at the COVID crash, and then watch the green line increase ever since. It doesn't take long to find the pattern that repeats itself over and over. The market always goes up. Yes, sometimes it takes a bit of time to rebound, maybe a few months or even a few years, but with a long-term perspective, the only way is up. So stick with a plan and go and get yourself a bargain, because that's exactly what I did when I bought some funds recently. My InvestEngine portfolio also had a pretty brutal time over the past month or so, from a peak of £504 in late December down to £479 in late January. Both the Developed Markets Fund and the Emerging Markets Fund have been hit hard by the latest blip, with the majority of the losses coming from the Developed World Fund due to the larger allocation. Whilst yeah, this isn't very nice to see, nothing has actually changed from my long-term investing plan, which I talked about last month. I know that I simply need to stick with a plan, keep a level head, and make sure that I'm investing every single month if I want to reach my financial goals, and my short-term returns aren't really going to change that. That's why I just deposited another £200, got it invested, and moved on with my day. This amount here shows my current account value if you are curious. One thing that has changed my approach to long-term investing though is the auto-invest feature that InvestEngine recently added, which automatically invests any cash in your account towards the funds in your portfolio. So if you click on this, whenever you get dividend payments or whenever you deposit money into your portfolio, InvestEngine will invest that money for you, so you don't even have to think about it. Just remember, if you are interested in using InvestEngine to invest with zero platform fees or to get access to other features like this, then you should sign up using the link in my description, where you get a free £25 for your troubles. Easy. But look, I do understand that looking at a few zoomed out graphs and focusing on a long-term investing mindset isn't necessarily going to help you forget about the big red numbers in your investing account, especially if those numbers are a bit bigger than the numbers that I just showed you. Because when we do leave our desk, have a coffee and finish our break, we still need to get back to the desk, sit down and finish the chuffing spreadsheet. So after you've had a break from staring at the red numbers and you've reminded yourself of your long-term investing plan, you can use this next strategy as well, which is going to help you beat bear markets, bull markets, any type of markets in fact, and it ties in perfectly with January's portfolio of the month. And this month's submission was sent in by Ed Crosby via Instagram, so well done mate, you've won yourself 30 quid. I'll be in touch. The masterpiece is a 6-fund global portfolio including everything that you would expect to see in a global tracker. The funds on screen show the entire portfolio, with 58% in the S&P 500, 13% in the emerging markets, 12% in developed Europe excluding the UK, 7% in Japan, 5% in the rest of the Pacific, and 5% in the UK. All of these combine to make a portfolio with just over 3,500 stocks and an average ongoing charge of 0.08%. Yes, you heard me right, 0.08%. And remember that this is on InvestEngine where there are no platform fees. So you're investing in an entire global portfolio with a total cost of just 0.08%. It's a passive investor's wet dream. It is probably the cheapest global portfolio that I've seen in the UK, but you might be thinking, how the hell is this going to help me with bear markets? Well, let me show you my point. If you were to invest in another low-cost global portfolio using Vanguard, the so-called kings of low-cost investing, you could invest in the FTSE Global All Cap Index Fund, where you'll pay an ongoing charge of 0.23% with a platform fee of 0.15%. So with everything included, your total costs are going to be 0.38%, which doesn't seem that bad in the grand scheme of things, but let's see how this plays out. If you invested £250 per month for 30 years with 6% annualized returns, when you subtract the 0.38% annual fees, you end up with just over 233 grand. But if you switch over to the InvestEngine portfolio of a month, that basically invests in the same thing, only cheaper. When you run the same calculation with 0.08% fees, you end up with over 247 grand. Now, when you compare the two amounts, it doesn't look that crazy, but you're getting an extra 14 grand just for investing in a cheaper portfolio. This normally comes with a caveat of, oh, it's harder to manage. More funds means more rebalancing. But remember, InvestEngine have a rebalance feature that does that for you, so you can't even make that excuse. Just remember that we compared InvestEngine to Vanguard. If we change those total fees to 0.7%, then the final amount reduces to below 220,000, which is around 27 grand less than the InvestEngine final amount. You absolutely cannot afford to underestimate the effect that costs have on your portfolio. If you choose to ignore them, then you will literally pay the price. But Lewis, what has this got to do with bear markets? Okay, I'll get to the point. We cannot control stock market returns. End of. And it makes no sense whatsoever to focus on the sides of investing that we cannot control. So instead, focus on what you can control. Costs are in our control. Yes, it's easy to think that we're at the mercy of the investment providers that set the rules, but you have a choice of which platform you use, so make use of that power. Because regardless of where the markets are going, up, down, sideways, whatever, the best that you can do is track those markets with as little fees as possible. The lower the fees that you invest with, the closer to the actual market returns that you're going to end up with. So finish your break, get back to your financial spreadsheet, and instead of worrying about how tough it is and how much you hate your boss, which is out of your control, take a deep breath and focus on what you can control, which is improving your understanding of financial spreadsheets by asking a colleague or watching a tutorial, and get the job done. So don't forget the importance of keeping a long-term mindset when it comes to investing, and never forget the importance of costs. Get yourself signed up to InvestEngine using the link below to make sure that you're investing with the lowest fees possible. And don't forget to send your portfolios into me to be in with a chance of featuring as the portfolio of the month and winning yourself 30 quid. But of course, there are more things that we can control to improve our investing results. And one of those is deciding whether to invest or pay off our mortgages early. And you absolutely need to watch this video here if you want to figure out the answer to that complex problem that most of us face, to make sure that you can become the best investor that you can be. Cheers.